So this is for the cash-rich, time-poor business owners who don't think that their money is working hard enough for them. And for the professionals, the dentists, the lawyers, the accountants, the auditors, all of whom also have a lot of cash but not enough time. They're wondering, why are their SIPPs or their ISAs, their pension pots, not looking something like this? What I've shown you over there is at the top, you've got this 105% return just by tracking an index, let alone picking individual stocks to beat it. And of course, it's been a fantastic few years. But why doesn't your pension look more like the blue line, which is the S&P 500, or even, well, you're probably not going to go into an India fund, so let's ignore that one. Even the UK one up 24%, which you probably wouldn't be happy with, because you might be thinking, why the hell didn't I put it into the S&P 500 and get 4 times the return over the last 5 years? Yeah, why didn't your fund manager, your IFA, do that? And I'll tell you the reasons why, and why your pension doesn't look like an index tracker. And the fact of the matter is, most people want to beat index trackers, and can private investors do it? Again, I'll explain why and how they should, without giving up their profession or their day job and becoming a stock market addict. If we're looking to invest, we probably want to look at, say, 15 stocks over 12 months. Okay, we can argue about the number of stocks precisely, but a 12-month holding period, look, 1 day's too short, 50 years is too long. And we'll review after 12 months. You might hold the same stocks for another 12 months after that, but we'll review after 12 months. The basic problem with fund managers and IFAs is this. IFAs will sell to fund managers because they get kickbacks, and the fund managers are restricted into the stocks they can invest in because they've been told, you, Mr. Fund Manager, are going to take care of UK growth. You, Mr. Fund Manager, are Japan income or Asia emerging markets value. Well, the problem with that is each of those funds will probably have at least 50 stocks. So if you own just 3 funds, that's 150 stocks. You've over-diversified. You've got too little money in any individual company, even if some of those names they throw at you are Amazon or Apple or Square or PayPal or whatever else. Actually, there's a bigger problem than this. Most people don't realize that their pensions are invested in the stock market to begin with. That's worrying enough, but we'll put that to one side. So the fact of the matter is, you can do it yourself. You can do it into SIPPs and ISAs. Obviously, you want to take care in terms of which stocks you look into. Probably the safest ones I can think of are the big cap names you've heard of, which are in the S&P 500, like a Microsoft. If you can think of a safer stock, go for it. If you can't, stay in cash or do index trackers. Have a look at the links in the bio where I teach a lot more as part of my campaign for $1million.com to teach 1 million people how to be better investors. But you should be doing a lot better in your pension, and you should be closer to that blue line. If you're not, worry.